All right, here's me walking through the Chapter 6 self-test that's provided in the Wiley information. I don't know if I'll do all the questions, but I'll do some of the ones that I think are representative, at least of, if there's repeats, or maybe I'll just go through all of them. We'll see how much time we have. The first question is, when the terms of sale are FOB destination, legal title of the goods passes to the buyer when the goods reach the buyer's place of business. So remember, FOB destination means free on board at the destination, which means that the legal title of the goods passes to the buyer when the buyer receives them at their place of business. So the answer to that one is true. Number 2, merchandising firms usually classify their inventory into raw materials, work in process, and finished goods. That is not true. Merchandisers usually just have finished goods. It's manufacturers that would have raw materials, work in process, and finished goods. Number 3, when is a physical inventory usually taken? When the company has the greatest amount of inventory, when the goods are not being sold or received, at the end of the company's fiscal year, or when the company has its greatest amount of inventory. And the answer is C, at the end of the company's fiscal year. That way you count up your inventory at the end of each year, and you can use the difference between the two, plus any purchases, to figure out how much you sold during the year, and kind of match that up against what your books say you sold. Anyway, number 4, which of the following should not be included in the physical inventory of a company? A is goods held on consignment from another company. B is goods shipped on consignment to another company. C is goods in transit from another company shipped FOB shipping point. So if we go through each one and kind of talk our way through it, goods held on consignment from another company so if I'm not holding them, but they're from another company, then that should not be included in my physical inventory. That is true. So it's either going to be A or it's going to be all of them. So let's look at B. Goods shipped on consignment to another company. Nope. That would not be included in my physical inventory. So B is out. C. Goods in transit from another company shipped FOB shipping point. Those would be included on my inventory because they were shipping point free on board. So this is definitely going to be A, goods held on consignment from another company. All right, so let's look at number 5. As a result of a thorough physical inventory, railway company determined that it had an inventory worth $180,000 at year end. Oh, I'm sorry, December 31st, so year end. This count did not take into consideration the following transactions. And then they're going to give us some transactions, and we have to figure out how to go about figuring what the correct amount of inventory should be. So I'm just going to bring over my Excel spreadsheet here, and I'll start with my original inventory number, which was it was given in the problem at $180,000. And then it says that we did not take into account the following. So Rogers Consignment Store currently has goods worth $35,000 on its sales floor that belong to Railway, but are being sold on consignment by Rogers. The selling price of these goods is $50,000. I skipped the first part. Rogers Consignment Store currently has goods worth $35,000 on its sales floor that belong to Railway but are being sold on consignment by Rogers. The selling price of these goods is $50,000. Okay, so if this is if this is being sold on consignment by Rogers, but they belong to Railway. If they belong to Railway, then they have to be included in Railway's inventory. So that is $35,000, and we do it at their cost. And then the other one was Railway purchased 13,000 of goods that were shipped on December 27th, free on board destination. So since they are the free on board destination, they won't belong to Railway till they get to Railway. So as of December 31st, they are not part of Railway's inventory. So their inventory should have the original inventory of 180,000 plus those consignment goods that belong to them. So that should be it. So it should be 215,000. And that's what we'll put. All right, number 6. Which of the following is not an inventory account? Work in process, that's an inventory account. Finished goods is. Raw materials is, but equipment is not. Even if you sell equipment, you would list any equipment that you had for sale as a finished good or as a merchandise inventory if you're a merchandiser. So equipment means the equipment you use in your company, and that's not an inventory account. Number 7, which of the following is not a legitimate business reason for taking a physical inventory? A, to check the accuracy of perpetual inventory records. B, to determine the cost of goods sold. C, to determine if any inventory has been lost from waste, shoplifting, or employee theft. That's usually called shrinkage. Or D, to verify the probability of individual inventory items. Oh, profitability. I thought probability doesn't make any sense. And so the answer to that one is D. You really wouldn't gain any knowledge about the profitability of individual inventory items by taking a physical inventory. But you would use it for all the others, A, B, and C. So D. All right. Number 8. Ownership passes from the or to the buyer when purchased goods are received from a public carrier if the goods are shipped, and then it wants you to think about that again, right? So just think about the names of them. Really, our only options are free on board shipping point or free on board destination. In free on board destination, it means ownership passes when it's received. So that's the answer to this question. Had it been sent free on board shipping point, owner would have passed before we received it when the seller shipped it. So that's just something we have to kind of keep talking ourselves through until we understand it. Number 9, ownership passes to the buyer when the public carrier accepts the goods if the goods are shipped. So this would be our FOB shipping point, right? So when we do shipping point, then as soon as the carrier accepts the goods, whether that's the mail, the U.S. mail or UPS or someone else, when they take the goods from the seller, they become the property of the buyer under FOB shipping point. All right, number 10. Which of the following statements are true? A merchandising company will normally have raw materials and merchandise inventory as inventory account classifications. That's not true. Merchandisers just buy stuff and sell it, so they'll usually list it as merchandise inventory. A manufacturing company will normally have raw materials, work in process, and merchandise inventory as inventory account classifications. That is true. Let's see. C, a manufacturing company will normally have raw materials, work in process, and finished goods. Oh, wait, B isn't true. They're trying to trick me. So manufacturing companies usually do not have merchandise inventory. They have raw materials, work in process, and finished goods. So C looks like our correct answer. And then D, as a merchandising company, will normally have raw materials, etc. So this is going to be C. Just remember, manufacturers have raw materials, work in process, and finished goods, and merchandisers have merchandise inventory accounts. Number 11, Cecil gives goods on consignment to Jerry, who agrees to try to sell them for a 25% commission. At the end of the accounting period, which of the following parties includes in its inventory the consigned goods? All right. So let's read it carefully. Cecil gives goods on consignment to Jerry, who agrees to try to sell them for a 25% commission. So the question is, who owns the goods? And the answer is Cecil. Consignment means Jerry never took ownership of them. He may have physical custody of them, but Cecil retains ownership. So that's A. Number 12. At December 31st, 2013, Sunrise Company's inventory records indicate a balance of $752,000. Upon further investigation, it was determined that this amount included the following: $112,000 in inventory purchases made by Sunrise, shipped from a seller, $74,000 in goods sold by Sunrise, and $6,000 goods received on consignment. What is Sunrise's correct ending inventory balance? All right, so I'm going to bring up my Excel spreadsheet here again, and we'll start with the original inventory, which was $752,000. And then we'll read each of these carefully. $112,000 in inventory purchases made by Sunrise. So this is something they bought and shipped from the seller December 27th with terms of FOB Destination, but not due to be received until January. So if they have not yet received them, then they do not belong on their inventory. So I'm going to subtract these purchases from the inventory, and the purchases were $112,000. Once we receive them, they'll reach their destination, they'll become ours, or become whoever this is, Sunrise Companies, and then they can be added to the inventory. The second bullet point is $74,000 in goods sold by Sunrise with terms FOB Destination. On December 27th, the goods are not expected to reach their destination until January 6th, so those rightfully belong on our inventory because they were sent or shipped to somebody FOB Destination. And since they have not reached their destination, they still belong to Sunrise. And then third, $6,000 of goods received on consignment from Wallwood Company. Remember, if we receive them on consignment, if Sunrise receives them on consignment, that doesn't mean they took ownership of them. So Wallwood still owns them, and they should not be included on Sunrise's inventory. So our new inventory then should be $634,000, which corresponds to answer D. All right. Number 13, under first in, first out, cost of goods sold consists of the units with the oldest costs. So again, talk ourselves through it. If first in, first out means the first things we purchased are the first things we sell, so that would mean that the units with the oldest cost, or the first purchased, would be the first ones sold, and that would be part of our cost of goods sold. So that answer is true. 14, inventory costing methods place primary reliance on assumptions about the flow of goods, costs, resale price, or values. And so this is kind of tricky. You have to think about what they mean. We're not really talking about the flow of goods. We don't care if it actually sold first or if it actually sold last. Instead, we're basing our assumption on the costs of the goods. So that's going to be B. 15. Cost of goods purchased is $540,000. Ending inventory is $20,000. And cost of goods sold is $560,000. How much is beginning inventory? So let me bring up my little spreadsheet here again. We know that sort of the basic way of thinking about this is beginning inventory plus purchases gives us something called cost of goods available for sale. And then our cost of goods available less ending inventory will give us our cost of goods sold. Of course, this is in a periodic system. So let's take a look at the information it gives us again. Cost of goods purchased is $540,000. Ending inventory was $20,000. And cost of goods sold was $560,000. That means our cost of goods available must have been 580,000, right? It's this amount minus the ending inventory gives us cost of goods sold. And so if this amount plus purchases equals our cost of goods available, that must be $40,000. So C. Which of the following is not an acceptable inventory costing method? So we have last in, first out. We have first in, first out. We have average cost. We've heard of all those, but we've never heard of last in, last out. So that's D. 17. Which of the following is true of the first in, first out inventory method? It assumes that the cost of the earliest units purchased are the first to be allocated to the ending inventory. B, it assumes that the cost of the earliest units purchased are the last to be allocated to the cost of goods sold. This is confusing. You have to read it very carefully. C, it assumes that the cost of the earliest units purchased are the last to be allocated to the beginning inventory. Or D, it assumes that the cost of the earliest units purchased are the first to be allocated to the cost of goods sold. All right, so stop and think. First in, first out. The first units purchased, the cost of the first units purchased, we're going to assume that those are the first to be allocated to the cost of goods sold. So which of these statements says that? It would be D. It assumes that the cost of the earliest units purchased are the first to be allocated to the cost of goods sold. 18. Which of the following would most likely employ the specific identification method of inventory costing? So remember, it's easiest to use the specific identification method when you have a relatively small amount of inventory, so a small number of items, and those items are relatively expensive. So car dealerships often use that. Grocery stores, not so much, right? They have tons of different products and they're all fairly low cost. Hardware stores, the same situation. Gasoline's almost impossible, right? You add gas into the tank and it all mixes up. But the jewelry store is going to have a bunch of items that they have ready to sell, and each one they'll have probably paperwork on and have a very specific price. So that is D, the jewelry store. 19. Which of the following statements are true? Last in, first out inventory. Valuation requires a physical flow of goods to be representative of the cost flow. That's not true. We've already established that this is more about cost than the physical flow. And so the second one's going to be false too. First in, first out requires physical flow. C, specific identification method inventory valuation requires physical flow of goods to be representative of the cost flow. Or D, all of these choices are correct. So the only one that it really matters that it matches up with the actual goods is the specific identification method. Because first in, first out, and last in, first out are just estimates because we don't know which items are selling when. It doesn't really matter, but with specific identification it does. If we say a certain car with a certain VIN number sold, then that's the one that had to sell. 20. Which of the following statements is true? Let's see, GAAP, as generally accepted accounting principles, dictate the method of inventory costing method a company must use. That's not true. Companies are free to use whatever they want within reason. B, the IRS dictates the method that they must use. That's also not true. C, the SEC dictates. Nope. D, company management selects the method of inventory costing. That's the correct answer. D. All right. 21, CAM company has the following units and costs. And there's a list of the units and the costs. If 9,000 units are on hand at December 31st, what is the cost of the ending inventory under the first in, first out, under first in, first out using a periodic inventory system? All right, well, let's bring up our spreadsheet again. So I'm just going to carry this information over. Inventory, January 1st, 8,000 units, cost of $11. Let me tell Excel that all right, purchase, June 19th, 13,000 units at a cost of 12, and purchase November 8 at a cost of 5,000 units at a cost of 13. All right. So on December 31st, they have 9,000 units on hand, which means that they must have sold what, 17,000 of these in order to have only 9,000 left. So the question would be, which ones are we assuming that they sold? If there's only 9,000 left, we're going to assume that they sold all 8,000 of the January 1st units. I'm just going to highlight that. And we're also going to assume that they sold a certain number of these. Let's see, how many did I say they sold? If they had 26,000 available and they only had 9,000 left, they must have sold 17,000. So they sold 8,000 of these, plus they sold, here, let's do this. So 8,000 of those, and an additional, I forgot how many I said, I think it was 9,000 of these. That would mean they sold 17,000 units, and the value of their remaining inventory they would have 0 of these left, and they would have 4,000 of those left, and 5,000 of those left, for a total of 9,000 left. All right, so the question, I hope this is making sense. So the question is, what is the cost of the ending inventory under a first in, first out system? So our ending inventory is going to include 4,000 units at $12, and it's going to include 5,000 units at $13 for a total of $11,300 worth of inventory. I'm sorry, 113,000. That makes more sense. So that is C. Hope everybody followed that. I kind of did it on the fly. All right, let's take a look at 22, which is just like 21, except it's probably going to do a last in, first out, which it does. So same company, CAM inventory. So now, let me unhighlight this. Now we're making a different assumption here. Under last in, first out, we're assuming that still the company had, let's see, 9,000 units on hand at December 31st. So they still sold those 17,000 units. We're just assuming they sold the last units purchased. So they sold 5,000 of these plus 12,000 of these. And the units remaining would be 1,000 of those $12 units and 8,000. So now if we're figuring out the value of our remaining inventory, we would say I have 8,000 units that cost $11 a piece and 1,000 unit that cost $12 a piece. So my remaining inventory balance would be $100,000. Let's see. That would be D. All right. Davidson Electronics has the following: inventory, purchase. Now they want us to do the average cost. So we'll do inventory on January 1st. Let me just delete all this. So the inventory on January 1st was 5,000 units at a cost of $8 a piece. And then they had a purchase on April 2nd, which was 15,000 units times $10 per unit, and a purchase on August 28th, which was 20,000 units at $12 per unit. It says they have 7,000 units left. How much is the cost of ending inventory under the average cost method? So to figure out the average cost then, first of all, let's figure out our total cost, where we take the number of units times the cost of the units. We do that for all three of these, and then I will add them all up. There's our total cost, and then we find the total number of units by adding them all up, and then we can find an average cost per unit, which will equal our total cost of 430,000 divided by our total number of units. So that comes out to $10.75 per unit. And then if we know number of units in inventory left in ending inventory, that was given to us as 7,000. To find the cost of our ending inventory, we just say that equals the number of units in ending inventory times the average cost per unit, which is $75,250, or the answer is B. All right, 24. In a period of inflation, last in, first out produces a higher net income than first in, first out. All right, so talk yourself through this again. In, first out, we assume that the first units sold, which would be the cheaper units, which would give us a lower cost of goods sold and a higher net income. And using last in, first out, we would assume the last units sold, which would be the more expensive units, which would give us a higher cost of goods sold and a lower net income. So that's going to be false, because in a period of inflation, first in, first out is going to produce the higher net income because it's going to produce the lower cost of goods sold. All right, 25. In periods of rising prices, what will LIFO produce? So same thing. So again, in a period of rising costs, just again, sometimes I just have to talk myself through these things. In a period of rising costs, the first in, first out method will assume that the cheaper goods, the ones I bought earlier, are the ones that sold, meaning the cost of goods sold will be lower. And so using last in, first out will result in a higher cost of goods sold. So last in, first out, since it produces a higher cost of goods sold, will provide a lower net income than first in, first out. 26. Which one of the following is not a consideration that affects the selection of an inventory costing method? Tax effects, balance sheet effects, income statement effects, or perpetual versus periodic inventory system? And I could talk our way through it, but honestly, tax is probably the biggest reason people choose one. They do choose the one they think will be the most tax effective for them. But also the way it impacts their balance sheet and income statement are things that will affect taxes. So ultimately, those are all related. So the answer is D, perpetual versus periodic is not a consideration. All right, 27. A company just starting business made the following purchases in August, and there's all that information. A physical count of the inventory on August 31st reveals there are 500 units on hand. What inventory method produces the lowest gross profit for August? So we can look at, let's see, we have 300 units. I'm assuming that's the total cost of the units. So we'd have to figure out if our cost per unit is rising or falling. So we'll do that real quickly. August 1st, August 12th, August 24th, August 30th. Number of units, 300, 400, 300, and cost. So our cost per unit then will be the cost divided by the number of units. And we'll see that we are clearly in an inflationary period, right, where the cost per unit is going up with each purchase. We're paying a little bit more and a little bit more. And so we could take the information we've just learned and we can say, all right, what inventory method produces the lowest gross profit? It would be the inventory method that produces the highest cost of goods sold. And since costs are rising, then the last in, first out method is going to produce the highest cost of goods sold, which will produce the lowest gross profit. So it's going to be last in, first out, B. In a period of rising prices, which inventory method will result in the greatest amount of income tax expense? So same argument, the one that's going to give you the greatest amount of income tax expense is the one that gives you the highest net income. And since we've already established that first in, first out is, let's see, period of rising prices, the greatest amount of income tax expense. Sorry, I'm talking myself through this in my head so I don't confuse you and don't confuse me. Okay, so in a period of rising prices, which inventory method will result in the greatest amount of income tax expense? So if we use first in, first out, that's going to assume, again, that we sold the cheaper ones, and that's going to give us a lower cost of goods sold, which will give us a higher net income. But if we use last in, first out, that's going to assume that we're selling the most expensive items, which is going to give us the lower net income, which is going to give us less income tax expense, since income tax is always based on net income. So the answer should be first in, first out. C. Sorry, you had to just hear my process, but sometimes you got to think hard about these things. Maybe for some of you, hearing my process will be helpful. For others, it might drive you bonkers. So hopefully I'm not killing any of you with this. And you can always speed it up to double speed or skip it if you feel like you understand one of these. All right, 29. Which of the assumptions of cost and price is generally rising? With the assumption, sorry, of cost and prices generally rising, which of the following is correct? Last in, first out provides the closest valuation of inventory on the balance sheet to replacement cost. First in, first out provides the closest to replacement cost. Specific identification method provides the closest cost of goods sold to replacement cost. Or last in, first out provides the closest valuation of cost of goods sold to replacement cost of inventory sold. Okay, so this is another one of those, again, where you have to talk yourself through it and say, all right, so in rising costs, last in, first out would mean that the last purchase is the first one sold. So that's probably the closest to replacement cost, right? So is it last in, first out provides the closest valuation of inventory on the balance sheet to replacement cost? Or is it last in, first out provides the closest valuation of cost of goods sold to replacement cost? And the answer is D. The last in, first out method provides the closest valuation of cost of goods sold to replacement cost. Why? Because we're using the assumption that it's the most recent items purchased that we're selling. And so since they were purchased most recently, they're going to be the closest to what it's going to cost us to buy next time or to replace that inventory. Number 30, in a period of falling prices, which of the following methods will give the largest net income? So in a period of falling prices, first in, first out will assume that the more expensive products are sold first because they're the oldest, which is going to give us a higher cost of goods sold and a lower net income. The last in, first out method will assume that the most recent purchases, which are the cheaper ones, since it's a period of falling prices, that they're the ones sold, which will give us a lower cost of goods sold and a higher net income. So the answer is last in, first out. Finally, number 31, two companies report the same cost of goods available for sale, but each employs a different inventory costing method. If the price of goods has increased during the period, which statement is true? So the company using last in, first out will have a higher ending inventory. The company using first in, first out will have the highest cost of goods sold. Okay, so again, we've got to talk ourselves through this and say, in a period of rising cost, last in, first out is going to yield, it's going to assume that we sold the oldest ones, the cheapest ones first. And so what we have remaining in inventory are the more expensive ones. So last in, first out will have a lower cost of goods sold and a higher remaining inventory. And I'm sorry, first in, first out will have that. And now I'm talking myself through it. So in, first out, we sold the older ones that were cheaper, right? So our cost of goods sold will be lower, and our remaining inventory will be our newer items that cost more. Under last in, first out, then we'll say the older, our cost of goods sold is higher because we're assuming that it was the last ones that we purchased, the more expensive ones, and our remaining inventory will be lower. Now I can look at these answers and say, the company using last in, first out will have the highest ending inventory. Nope, that wouldn't be true of last in, first out. The company using first in, first out will have the highest cost of goods sold. So first in, first out will have a lower cost of goods sold, so that's not true. C, the company using first in, first out will have the highest ending inventory. That is true. And then D, the company using last in, first out will have the lowest cost of goods sold. That's not true, so it's got to be C. So you do have to puzzle your way through each of these, which means you have to really understand how all of these things are interrelated. I can grade my test, and it says I got 97% correct, which means I must have missed one. Let's take a look and figure out which one it was and make sure I didn't lead you astray. All right. And it's number 4. It says, which of the following should not be included in the physical inventory of a company? And I put goods held on consignment from another company, which I thought that's what I put, and it says that's the correct answer. So maybe I just forgot to click it or something because it's not showing me what my wrong answer was. So anyway, that's true. Goods held on consignment from another company are not included, right? Because you have physical possession of them, but you don't own them, so they're not part of your inventory. Okay, that's a pretty long video. I hope it was valuable to some of you at least. And again, remember what's cool about this system is you can watch them double speed, you can skip around. So if you found something that was valuable, I'm glad. And if not, then don't use it. Have a good week and good luck on the test.